talk about jobs, and that has been the story all week long. So much information came out that certainly shows that all of the Fed's hard work of trying to slow the economy down certainly is working, Derek.
Right. We're starting to see signs of cracks in the jobs market. We saw jobless claims were up. We saw hiring intentions were down. We saw the ADP labor report miss expectations. We saw PMI services and manufacturing post worse than expected results. So the risks would appear to be on the downside from an economic perspective. And as a result of all that, the odds of a Fed hike in May have dropped from over 70% to under 50 at 46% currently.
And so you talk about the rate hiking cycle. Of course, we all know that they did 7 last year, the Federal Reserve, 2 this year, and some were expecting 1 more when all of this data comes out. But if they are at the end of the rate hiking cycle, Derek, that could suggest a lot of things to the economy.
Right, and I'd be careful. When it becomes apparent to everyone that the Fed has paused, it's because they think that what they've done has been sufficient to reduce inflation going forward, but also that the economy is cooled significantly, and that can be a risk, right? If the Fed has to then turn around and cut rates, that's because they've broken something. So historically, stocks do extremely well during the pause period, provided that it's not followed up quickly by a rate cut.
There's a lot of outcomes that could happen here, and you did a nice job with the committee this week, and I'd like to share that. But, there's a number of outcomes. One of them is a hard landing. In other words, a deep and long recession. One of them is a stagflation type of environment where we're going to have a stagnant economy and still inflation continues on. And then the other is a soft landing. In other words, it slows down, but we don't have a recession.
Right, and the stagflation and soft landing are really kind of part and parcel of the same thing. The question really is, has the market and has the economy fully discounted the effects of these monetary policy tightening moves, whether it's higher rates or quantitative tightening? And in our view, they have to a great degree, which is why we're somewhat optimistic about the back half of 2023 into 2024. We're going to learn a lot in the coming earnings reports. Have companies sufficiently lowered the bar? We're going to get the banks starting on April 14th. Those are obviously going to be key reports. And then going forward, we're going to get guidance, which we're going to take a real hard look at, because right now, analysts have only lowered their estimates from 10% from what their peaks were prior to when the Fed began raising rates. And they're looking for earnings in 2024 to be up 10%.
We talk about, all of the talking heads and what's going to happen. And that's the reason why I really liked the continuum that was put together of best case, worst case, and base case. In fact, we don't know. The economy doesn't know. Powell does not know. And that is the reason why you put those out there and say, how do we match our risks and try to get a return? And that is really the core of investment planning.
Yeah, and our current positioning reflects our beliefs. I mean, we're basically neutrally positioned in equities. We have somewhat of a defensive tilt. We're a little bit underweight tech. We're a little bit overweight healthcare. We're also underweight financials. So I think we've been positioned reasonably well. The real question to me is whether it's going to be large stocks that outperform for here or small stocks. Small stocks are extremely cheap, but it all depends on what index you're using, because in the Russell 2000, over a third of the companies don't make money, and a rate hiking cycle is not good for companies that earn nothing.
And in the last 15 seconds, we're watching WTI and oil very closely.
Right. OPEC surprised everyone over the weekend by cutting production or announcing production cuts of 1.1 million barrels a day. And Russia joined the party and said they're going to reduce production as well. So oil prices bounced significantly to over $80 a barrel. And that only makes the Fed's job that much more difficult, particularly as China reopens.